This is one of the reasons I'm not a big believer that if we have a recession in the world or in Europe specifically, it won't be long. It'll be short-lived because of all this fiscal stimulus. So all of these are changing. And gosh, Dom, I don't think I would have been talking about any of this right now 4 months ago, 5 months ago. So here I am really talking about how this is all shifting and how should we think about it.
You know, in your recent letter to CEOs, you talk about that we focus on sustainability not because we're environmentalists, but because we are capitalists and fiduciary to our clients. And I would love for you to speak a little bit about what that means.
Elevated prices like we're seeing now will accelerate new technologies, will accelerate substitution. And so the pathway for sustainability is real. BlackRock has always said we don't believe in divestiture, and I think we've been very firm on that. So we believe the transition is going to be long. I wish we had the technology that we could turn a switch on and become green. The most important thing, and this is so evident in LATAM and in every other place in the world, any transition to work has to be fair and just. Higher prices is not fair and just. It hurts the poor. It hurts the poor countries. And that's what we're witnessing now. We're witnessing the spike in food, the spike in energy, and it's really a major tax on when you think about the percentage of the average person, whether they're in the United States or Mexico or Brazil. I mean, there's differences, but the amount we need to spend for energy and food as a percent of our living and our wages has grown dramatically. And these are real structural issues. Getting back to transition, and I'm a firm believer that this transition will happen. I'm a firm believer that we have to invest side by side with hydrocarbons and investing in more decarbonized technologies. And I do believe, we have to judge those pathways and manage those pathways successfully. This is a long-term complex process. And, as a result of these higher energy prices, I think the world is going to have more hydrocarbons in the air next year than ever because we're utilizing more coal than ever before, because coal is still cheaper than some of the other hydrocarbons. But let's be clear, the prices that we're witnessing now is going to accelerate new technologies for decarbonization.
And what we're seeing right now in Ukraine really represents a supply shock on top of an existing supply shock already that was very much related to the restart dynamics, because the supply is not switching on fast enough to meet the demand that is coming back online. And we already had a heightened inflationary pressure coming into this year. And the tragic war in Ukraine is just adding further the supply shock on top of supply shock, and specifically the transmission mechanism through energy, through agriculture, through other commodities. If you think about Russia representing 10% of the global oil and 17% of global gas. So all of that, the events so far this year represents actually inflation will be here to stay. It's rising higher. Our expectation for inflation for this year is higher, and also it means that it actually will settle at levels that are higher than what we got used to pre-pandemic.
I would say that the recent events are, as you touched upon, making things different in different regions. Europe is being definitely hit harder because of their, closeness to the conflict, to their dependency on Russian fossil fuels. It seems for the U.S., the situation might be quite different. They're less dependent. The U.S. is much more efficient than it was years ago when it went through the last oil shock. It's also much more dependent on its own production. So how do you see those differences, evolving? And as an investor, does that have any repercussion?
Absolutely, Axel, you're spot on in that the read across of what is happening right now through to Europe, through to the US is really quite different. And that is in part why we recently pivoted in our asset allocation slightly away from European market, European equities, and slightly more towards the rest of developed market, including the US and including Japanese equity market. So this very, very intense kind of reliance on Russia and in the case of Europe is why we see greater vulnerability of the economy for the rest of the year. And this is also why when we look at earnings forecast for European equity market and we compare that with the US, we see actually, yes, indeed, both Europe and US entered 2022 with its equity market forecasted to deliver and grow earnings by high single digits. Right now, European equity market earnings per share forecast has been moderated down to mid-single digits. So from high single digits to mid-single digits. But we don't think that downward revision is enough. We think that given the macro vulnerability that I just talked about, actually, it's entirely possible that European equities do not grow earnings at all this year, right? So further downgrade to come in our view for European equity market, which is also why we're currently we pivoted away from European equity market a bit in the recent Q2 second quarter outlook. And the equivalent earnings growth for the US equity market.
Certainly, Wei, and very much so. Emerging markets, as you described, the difference between the U.S. and Europe is pretty much also the characteristic. You have emerging markets, especially those in Asia, which are very much more dependent on consumption of a lot of the commodities that you mentioned have risen in price. Of course, energy, food, industrial metals. But at the same time, you mentioned Latin America. It definitely provides pretty much kind of an unexpected opportunity, at least in the short term, to see those commodity prices stay higher for longer. Now, it is a mixed situation. Although many of the economies in Latin America, be it oil, be it copper or crops, are significant contributions to economic activity. At the same time, they're also having to deal with quite high levels of inflation. And not just now, since last year. So central banks are pretty much way ahead of what has been going on in developed market central banks, such as the Fed or the ECB. So that is already taking a toll on economic activity. So it's kind of a balance. Quite more positive with this higher commodity scenario, a super cycle, if you will. We can talk a little bit if this is more structural or just responding to the current events, but also having to confront kind of central banks putting the foot on the brake to contain these inflationary pressures. We're already seeing that flourish in some of the recent figures, or even more so on what central banks have been doing in terms of the forecast, be it the Central Bank of Brazil or more recently here in Chile. They're, as we mentioned, they're pretty much acknowledging that they will have to live with inflation for some time higher, meaning that probably they won't be as aggressive as they want to, because they don't want to necessarily push their economies into a very bleak economic activity situation. So they'll have to kind of content themselves with inflation sticking around for a little bit longer, but yet, looking out for those longer term inflation expectations not to be de-anchored. A very, very difficult balancing act that we'll see from a lot of the central banks in the region. So I guess it's not an easy time to be a central banker, and less so, I guess, an investor. So the question back to you, Wei, and related to economic policy, what are your thoughts. What has BII thought about, the policy response from the Fed or the ECB in this higher inflation situation, but with the uncertainty that the recent events have brought?
Absolutely. Actually, Axel, you're absolutely right in that Latin America has actually done really well so far this year in terms of the asset price, because even though the food inflation makes up a bigger percentage of emerging market inflation prints, Latin America being exporters of some of the commodities being impacted have had a bit of an offsetting factor, which has supported the market. So that's a great point. The impact on the net zero transition is perhaps also a bit more nuanced in comparison, comparing Europe and the US, in that whilst it's acting as a bit of a, in our view, accelerator for the net zero transition in Europe, the US probably wouldn't feel as strong a push as the Europeans do, because at the end of the day, the US is a net primary energy exporter. And in fact, in order to make up for the decrease in energy imports of Europeans from Russia, the US will have to increase production in order to compensate for the reduced Russia supply for Europe. And as I said earlier, the US has a lower energy cost burden, so it feels the pressure a bit less.
But you look at the upper left, and you look at one of the things that I think has got the Fed concerned, and that I think is clearly going to be an impact going forward, is you look at that green line, which is core services. You've got an acceleration of wages that is taking place. You see this in the employment report that we got on Friday. You continue to see this acceleration of wages. And then you look at supply chains and you think about China and lockdown, and how do you get these supply chains unlocked? And then on the upper right, deglobalization. So listen, you can't even talk about investments today without talking about inflation. And then, the trickier thing is emerging market growth is still very uneven. And, you have this really difficult dynamic in EM where inflation is higher and the central banks are raising rates across much of EM to try and manage that. But simultaneously, you've got a growth paradigm that is slowing. So listen, I still think it's being a bit cautious around emerging markets, tactically add in some places. I'll talk a little bit about, hard currency. We prefer hard currency today. And, the valuations, we show on the upper left, these valuations are still pretty attractive. 22 has been hard across virtually everything. So, it's hard diversifying when you look at that 2022 line. And by the way, it's been a little bit better in March, the last column, where equities have done a bit better. But, it's pretty hard to diversify when everything is red, but except for oil and gold. By the way, part of it, depending on how you can diversify, I still think oil and commodities and agriculture are still going to be very well supported. Talk about diversification. We're buying some credit. And we're buying some investor grade credit and quite frankly, holding it in yield to create a bit more balance in a portfolio. It's been all about buying equities, but I think today you can actually take some yield into your portfolio. And if you said where are rates going, I think rates are going higher. I don't think they're going much higher. I think they're going higher. But boy, if I can carry through the end of the year owning some of these yielding assets, try and take some credit spread, maybe shorter on the yield curve, and then